Morning, Steve, and thanks for reminding me of that conversation. Well, I think, look, there were two parts to that story. One of them was that, bond yields would need to go up. And as you say, that's taken a long time to happen, but we're starting to see it. The other was that equities were cheap and were likely to generate very good returns. And of course, we saw a fantastic decade of returns for equities. I think we're going into a more difficult period, not just in the short term, but more structurally, because part of the reason that equities and other risk assets did well in the last decade is that the risk premium was high, valuations started at a low level, and interest rates continued to fall through the decade. And we're not going to see that again. I think there is more room for interest rates to rise. Of course, the market is pricing quite a lot already. But when you consider that, 10-year Treasury yields, for example, before the financial crisis were above 4%, that isn't a forecast of where they're going to go, but there's room for them to go higher if inflation continues to remain more entrenched and we don't get a recession.
In terms of that next decade, then, just very briefly, I know because we'll get back to your piece in a while, and I know Jeff's got his own questions. Does that mean that the bond market continues to fall and yields continue to pick up, and the equities will not have, well, they won't have double-digit inclines on an annual basis? Will they have any inclines on an annual basis?
I think they will. We should acknowledge that actually equity valuations have come down now quite a lot. Even if you look at simple PEs in most markets, take Europe, they're now below their long-run averages. That's true across Asia, EM. The US is still a bit of an exception. But it's important to understand, I think, that in a way, equities are a real asset. In the end, they're making a claim on nominal GDP. And one of the key things about the last decade after the financial crisis is that nominal GDP trended downwards. And there were lots of concerns about recession and deflation and falling earnings and dividends. With rising nominal growth, these dividend yields were effectively a real yield. So although the aggregate returns are likely to be lower, I think equities can compound at a reasonable rate in real terms. And it's very difficult for bonds to compete with that when you think about the starting level of bond yields in a more inflationary environment.